When we talk about safe REITs, hospital or healthcare REITs are always the first thing that comes into a lot of people's mind. However, if you see for this REIT in particular, First REIT, it has not done well throughout the years. As you can see, there's a huge drop in the share price of 70% since 2019. So in this video, we'll go through the First REIT history and performances and why it's still priced at a 10% dividend yield. For those who are new to First REIT, they are actually quite similar to Parkway Life REIT, where they contain hospitals and nursing homes. The differences is that rather than concentrating in Singapore and Japan, they are actually concentrated a lot in Indonesia. This REIT has a very interesting tenant profile. If you see, it's very concentrated, with the top 2 tenants having a rental income contribution of 73.6%. Now, having concentrated tenants have its pros and cons. The good thing is that they only have to care about 2 tenants for most of their rental income. However, this also means that the REITs depends a lot on these 2 tenants for income, and thus, if these tenants do not want to pay or want to pay at a lower price, the REIT has to oblige to it. This will be seen later when we look at the history of this REIT. If we look at the performances of these 2 tenants, Siloam International Hospital is performing quite okay. But if you see Lippo Karawaci, they are actually performing quite badly. As you can see that for the 5-year chart, they have actually dropped by 68% in share price. The bad performances in their major tenant is also one of the reasons why the REIT has been dropping in the share price from the past few years. In the later part of the video, I'll share the one event that has caused the REIT performance to change because of this tenant. Now let's take a look at their finances. You can see, unlike Parkway Life REIT, their DPU has actually dropped year over year by 6.1%. The main reason is because if you see their distributable income has dropped by 1.9% because of lower rental incomes and lower NPI. What is the main reason? The main reason is because of higher financial costs and the depreciation of foreign currencies. For First REIT, its situation is quite similar to Fraser Logistic and Commercial Trust, where they are focused on overseas countries. For First REIT situation, they are actually focused on Indonesia and Japan. Unfortunately, both currencies are actually facing a weakening as compared to SGD. Therefore, when it's converted to SGD for dividends, it will naturally be lower. I'm not so much concerned about Japan yen, but I'm more concerned about Indonesia rupiah, because if you can see historically, it has been increasingly weakening against SGD. So naturally, this will be a pulling effect for First REIT, because over time, even if the properties improve, but the currency weakens at a very fast pace as well, this will naturally bring down the dividends given to SG shareholders. The management also has made some questionable actions based on the First REIT that I'm reading from here. You can see from their debt maturity profile, they have actually refinanced their 2025 loans to 2030. Their cost of debt is still on the consistent rise to 5% from 3.7% over the past year. However, the positive note is that they are increasing their hedge to 87.2% of the debts. Moreover, even with this high cost of debt, their interest coverage ratio is still at 4.1 times. This shows how resilient they are in terms of the income to the debts payment. Next is the part where I feel that a lot of investors are afraid when it comes to investing in First REIT. The relationship between the sponsor OUE and the Indonesian huge tenant Lippo Group has been questionable at times. So you can see, for Lippo Group, they actually owns the sponsor plus the 2 big tenants. So ironically, in 2020, they had a restructuring for the hospital master lease tenant between one of their biggest tenant and another smaller tenant in Indonesia. When this REIT was first IPO, it was agreed that the hospitals in Indonesia will pay the base rent in Singapore dollars. However, the new proposed structural change will make the hospitals pay in Indonesian dollars instead of SGD. So this actually brings about currency risk to shareholders. Funny thing is, if you can see from the illustrate base rent, they have actually compared the new proposed plan and the new old plan of 4.5% increase over time and 2% of the cap. But if you see the note below, this 4.5% illustration does not cater for any fluctuation in the currency strength. At the point of illustration, the exchange rate was $1 to 10,830. Comparing the rate now, it has actually depreciated by 14.19% to be exact. So I think because of all these restructuring actions in the past, OUE in Singapore does not have a very good reputation to some shareholders. Of course, past performances do not reflect the future performances. At this share price, First Reit might be a good opportunity to start investing in. But in my opinion, I feel that the sponsors and the REIT itself does not cater in favor for shareholders. The huge dependence on two tenants for most of their rental income is also another concern, as we do not know if the tenants continue to not do well, new structuring might happen again and they might lower the rental income even more. So this is something that you must take note when it comes to investing in First Reit. So similar to other REITs, not only does the balance sheet has to be looked at, the sponsors and the tenants plays a big part in ensuring that the REIT gives a healthy dividend level. I hope this video helps. Please hit the like, subscribe and comment on what you feel about the potential of First Reit. You can also watch my other videos where I select the best REITs and why I'm bullish on Singapore banks. Thank you and see you in the next video.